and welcome to this December Future Influencers webinar. I am John Wilson, Head of Technical Research and Policy at Dalriada, and just before I turn to today's agenda, just the usual bit of housekeeping for these events. We are on a Teams live platform, so the only people you will see and hear are today's presenters, who I'll get on to, but you are still, as always, very much encouraged to engage with the presentations today, and you can do that in the usual way using the chat box icon, which hopefully you can see in the top right of your screen. I'll keep an eye on any observations or questions that are posted, and we'll stop presentations at an opportune time to address any issues, and there should be plenty of time left at the end of the session for a bit of a sweep up as well. So if we could move on to today's agenda, please. And one forward again, please, Cass. Thank you. So delighted to say that I am joined today by Callum Smith from Barnett Waddingham, and together we're, I suppose, doing a bit of a retrospect on 2020. I'm going to kick off looking at some of the developments in pensions law and practice over the past 12 months, and maybe towards the end, if there's time left, just spend a couple of minutes on what I think might be the milestones from a pension scheme perspective in 2021. I am then handing over to Callum, who is going to look at the investment year in review, and very much looking forward to that, because I'm sure I don't need to tell anyone that from a pension scheme investment point of view, it has been a roller coaster of a year. So as indicated on the agenda, I'm going to start with the first half of this two-parter. And if we could just move on one again, please, and hopefully that'll take us on to Q1. So, beginning of 2020, now I know that many people, myself included, probably want to try and forget about 2020, but I think, at least from a pensions perspective, it's going to be a year that will be remembered for quite a bit more than just the acceleration of a kind of new normal in terms of how we work and indeed live. And in fact, a lot of the developments from a pension scheme perspective in 2020 were actually in the first few months of this year, before any of us maybe even knew what coronavirus or COVID-19 actually was. And I think another thing that we will see in terms of pension law and practice developments is 2020 has been a bit of a year of themes in terms of legislation, cases, and the pensions regulator as well. So just going back right to the start of the year, what we saw was the reintroduction of the Pension Schemes Bill into Parliament. Now, this followed the dissolution of Parliament at the end of 2019, because the bill had actually already been introduced into the House of Lords. And as we'll see, as we progress through this retrospect, the bill has progressed throughout the year, and we'll return to it probably right towards the end, just to consider where it actually stands and what the likely final content will look like. But enough of the bill just now. The pensions regulator started the new year with the publication of its latest defined benefit pension scheme return, which will be issued to pension schemes early in 2021, and it should be noted, contains a new question on employer covenant and a request for website links to publish statement of investment principles, which of course now should be publicly available where a scheme is subject to the requirement for a SIP. The PPF saw a bit of a milestone at the start of 2020 with the Carillion pension scheme becoming the 1,000th scheme to transfer to the PPF since its inception, which, remember, was only around 15 years ago, and it is now well above 1,000 schemes in terms of providing a safe harbour when an employer becomes insolvent with an underfunded defined benefit pension scheme. How many more schemes will enter as a result of the economic impact of the global pandemic? Now, only time will tell, but I did listen to a PPF webinar quite recently, and the PPF board is already starting to factor this into its modelling. If we could move on, please, to the next slide. Some other highlights from the first quarter of 2020 then. I think, just to pick out a few, we saw the courts grappling with more RPI, CPI cases where trustees and employers were looking for clarification on the correct measure of price inflation for increases to pensions and payment. And pensions indexation is actually another 2020 theme to which I want to return in a few slides' time. In terms of regulatory developments, changes to pension scheme internal dispute resolution procedures to reflect the Money and Pension Service, MAPS, bringing in the three existing financial guidance bodies, the Money Advice Service, the Pensions Advisory Service, and PensionWise. And I know this is not a major development, but I mention it because I still see IDRP procedures being sent for review, where they are not referring to the new Money and Pension Service as per the regulations they should be. Stephen Timms agreed to fill the big shoes of Frank Field following his appointment as chair of the Work and Pensions Committee. And in Q1, believe it was that long ago, we also witnessed a quite high profile and maybe a little acrimonious cabinet reshuffle, which included the resignation of Sajid Javid as Chancellor and his replacement by Rishi Sunak. And if we can move on again, please. So continuing with the quarter, the pension regulator published its response to a consultation on the future of trusteeship and governance, a consultation which received a record 114 written responses. I suspect that this is something that we'll hear more about in 2021. The pensions regulator also published the first stage of a major consultation on its revised code of practice for defined benefit pension scheme funding. HMRC now publishing the first of two newsletters on the pension tax implications of addressing inequalities arising from guaranteed minimum pensions following the 2018 Lloyds Bank pension schemes cases. And in March 2020, in the budget, there was an increase in the level of adjusted income at which the annual allowance is reduced from 150,000 to 200,000, with the minimum tapered annual allowance reducing from 10,000 to 4,000. At that point, a consultation on reform of RPI was also published. And again, I'll come back to that consultation. But will the reduction in the annual allowance for high earners maybe be reconsidered in light of the impact of coronavirus this year, and in particular, people dipping into pension savings or cutting back on pension savings because of some of the economic impacts of the pandemic. I think suffice to say that pensions and taxation is something that we will be reviewing again come 2021. Oh, and there was, of course, the minor issue of the European Union Withdrawal Agreement Bill, which received royal assent, allowing the UK to leave the European Union on Friday, 31 January at 11 p.m, subject to a transition period which ends at the end of this year. And Brexit is another theme to which we will return. But unless anyone's been on another planet, I think we all kind of know that at the moment we are waiting on tender hooks to find out whether we are leaving the European Union with or without a deal, and we should find out fairly soon. So I think suffice to say that pre-COVID 2020 was a busy time in pensions, and I think, as we'll see from the slides that follow, things did not let up in the post-COVID environment. So if we could move on again, please. And just move on again. I think I've covered the ones on that slide. Thank you. Okay, so on to Q2 2020. Now, the second quarter of 2020 saw more failed attempts by pension scheme sponsors to reduce their pension liabilities through changing the measure of price inflation for pension increases from RPI to CPI. And actually I attended quite an interesting legal webinar recently looking at how these cases might have had different outcomes if we were already in a position where the decision for RPI to be aligned with CPIH had already been implemented. But we now know that that particular change is still a number of years away. The second quarter also saw the publication of the Pensions Regulator's annual funding statement. Now, not surprisingly, this focused on guidance for completion of valuations in the COVID environment. Coronavirus, at this point now being headline news, and the statement was both preceded and followed with specific TPR guidance designed to help pension scheme trustees and employers cope with the financial impact of COVID-19. And some of the guidance is still in force. In another response to the pandemic, new legislation, the Corporate Governance and Insolvency Bill was published to provide greater opportunities for company survival and better returns for creditors during and after the COVID-19 emergency. The bill, which is now an act, does though have important implication for pension schemes that are material and usually unsecured creditors of their sponsoring companies. So a piece of legislation not directly aimed at pension schemes, but an act that trustees very much need to be aware of, particularly where they are concerned that their sponsor may be becoming stressed or distressed. If we could move on to the next slide, please. So getting towards the end of Q2 2020, last but certainly not but by any means least, we received the first instalment of interim super fund guidance, setting out the pensions regulator's expectations for defined benefit consolidator super funds. We also got the High Court ruling in the Hughes case, where it was held that the Pension Protection Fund compensation cap is age discriminatory. Important case, but I'm not going to go into a lot of detail during this part of the presentation because, again, as anyone impacted by it will be aware, that this ruling is now being appealed. So this particular issue is, I suppose, a case of watch this space. And I think in terms of material development, that brings us to the second half of 2020. So if we could move on again. So the third quarter of 2020, I suppose comparatively quite a quiet 3 months, but still notable for at least a few reasons shown on the slides here. Another Barber equalisation window case in the form of Safeway and Newton, but probably a case of very, very limited application. More on guaranteed minimum pension equalisation in the form of the second HMR newsletter, which I already alluded to, this one covering lump sum payments, And we also saw guidance from PASA, the Pensions Administration Standards Authority, which covers both data and member communication in the context of GMP equalisation. Then we got a pension tax relief consultation, which was mainly to consider the impact of low earners and pension tax relief. But I think for many that this might be seen as the thin edge of the wedge in terms of a prospective, more far-reaching reform that could potentially entail the end of marginal rate relief on pension contributions. It is an issue I see coming up again and again. I thought we might hear something about it in the autumn statement, but it looks now as though we will need to wait until the 2021 budget, whenever that might be, because it is possible we won't see traditional timescales in 2021. If we could move on again, please. Also in this quarter, a consultation on climate change. Now, I think a topic which seems destined to become one of the issues of the decade for pension schemes. Another consultation, but this time on defined contribution schemes, DC outcomes, which for many in terms of practical impact is probably going to mean further consolidation of DC pension schemes, essentially setting certain metrics for DC governance, which if they cannot be met, then the schemes should consider consolidation, possibly into a master trust. Actual legislation, as opposed to consultation, providing that debts owed to HMRC following company insolvency are to have secondary preferential status from this month, and more updates to the pensions regulator COVID-19 guidance, specifying that from the beginning of next year, defined contribution schemes and DC providers will be asked to resume the reporting of late contribution payments, and that from 1 October 2020, other types of enforcement start to return to normal. So, for example, normal reporting requirements. And this actually brings us to the current quarter of 2020. And I think as we reflect on the year and look forward, hopefully to 2021, where life will start to return to normal and the focus will be more on economic recovery, I think it's evident, at least in the pensions world, that the one thing that we can be sure of is probably more change. So if we could move the slides on again, please, and we'll look at this last quarter. Just move on again. I think I've covered the TPR updates. So beginning Q4 2020, the PPF issued its draft PPF levy determination for next year, confirming a levy reduction for 2021-22. The key question, of course, is, that many people are debating is what will the levy be in future years when the full economic impact of the pandemic takes hold. It's hard to look at a precedent for this, but I did look back at what happened after the financial crisis, so maybe 2008, 2009. PPF transfer cases in the few years that followed. It seems inevitable that there will be an increase in PPF assessments again, and the impact of that may well indeed feed through to the Pension Protection Fund risk-based levy. At the beginning of Q4, there was also guidance for trustees and employers considering commercial consolidators or super funds as a possible risk transfer option. And we saw the introduction of the concept of gateway principles, where broadly these are commercial consolidators should be considered where the scheme cannot afford to buy out now, the scheme cannot afford to buy out in the foreseeable future, and the transfer to a super fund improves the likelihood of members receiving a better outcome, ideally the full benefits, of course. And if we could move on to the next slide, please. Now, the pension scheme bill, which I mentioned right at the start, is close to royal assent, and in terms of those final measures within an act, there are important provisions around pension regulator powers. A huge amount of debate for that, but the government has not moved on the ambit of the regulator's powers. So we await pension regulator guidance on how they might be applied in practice. The bill currently also contains measures on scheme funding, on collective defined contribution schemes, on the pensions dashboard, and on possible restriction on transfer rights and more measures on climate change. So there's that climate change theme arising again. In this quarter, the regulator also asked us to pledge to combat pension scams by signing up to their latest campaign for protecting pension savers. And maybe on a slightly related note, the High Court clarified how the legislation governing the Fraud Compensation Fund should be interpreted, hopefully paving the way for pension scam victims to claim compensation from the Fraud Compensation Fund. But there is a lot of work to be done there in terms of how claims might be made and what claims would be eligible for redress. If we could move on to the next slide, please. Okay. More recently, the High Court told us in the second Lloyds Bank pension schemes case that trustees of defined benefit pension schemes, which provide guaranteed minimum pensions, are required to revisit and, where necessary, top up historic cash equivalent transfer values that have been calculated on an unequalised basis. Now, I think nearly all practitioners in the pensions industry are still digesting exactly what this case means in terms of how much work needs to be done in identifying unequalised past transfers out and how redress should be made. What is clear is that a top-up should either be in the form of another payment to the receiving scheme for the original transfer value, or a payment direct to the member. The members involved in past transfers out do not have the right to residual benefits in the transferring scheme. I suspect that going forward, many pension schemes affected by this ruling will be looking at making direct payments to members. But before they do so, what we need on this is a bit of clarity around how such payments should be designated from an HMRC perspective and what that means in terms of their taxation. So I don't expect many pension schemes to be actually actioning this particular ruling until sometime in 2021. Moving on, the government confirmed that the Retail Prices Index will be reformed to align with the Consumer Prices Index, including owner-occupiers' housing costs, but not before February 2030. Again, you know, the impact of this development, which has been a long time coming, needs quite a bit of careful consideration. It's not simply a case of pension scheme liabilities will reduce because in future members' benefits will increase at a slower rate. The impact of this particular issue, and it may even be something that Callum touches on as well, very much depends on both the assets and liabilities of each pension scheme that is affected. And really, you know, at the time of today's webinar, that brings us to the end of the key developments that I wanted to highlight for 2020. So before I pass over to Callum, if we could just move on again, and I think I've got a few minutes left, so maybe a bit of crystal ball gazing now and have a think about what we might be talking about when we do a retrospect of 2021. Well, it's early days, But I think a few things that we can be fairly certain about are discussions around the pension implications of Brexit, and in particular the end of the transition period, and whether that is with or without a deal being reached. The economic fallout from COVID-19, and that is not just going to be a 2021 issue. I suspect it will be an issue of this decade. Budget 2021, and whether the cost to the exchequer of the government support schemes like furlough, which I understand has reached about 300 billion, whether any of the cost of that will be recouped from changes affecting pension schemes. GMP equalisation, as we are now past 2 years since the original Lloyds Bank ruling, it is the expectation, that some schemes will finally be doing it, and not just schemes that are looking at buyout, where GMP equalisation has to be addressed. More work for the PPF in light of the Hampshire ruling, the Bauer ruling, the Hughes ruling, and what that means for PPF compensation and for levy payers. And indeed, the PPF will also need to consider the most recent Lloyds Bank case on past transfers, because it has been suggested that where there were unequalised past transfers out for a scheme that has now transferred to the PPF, that there may be the possibility that the PPF will need to consider top-ups for those past transfers out. And we've got the guidance, and I think we can expect the legislation for commercial consolidators and super funds to appear in 2021. In fact, it was actually indicated by the Pensions Minister that there would be another pensions bill introduced into Parliament this year with the primary legislation for super funds, but it seems a bit late in the day now. It might be January before that appears. The pensions regulators' consultation on a new defined benefit funding framework will continue, and hopefully we'll see the benchmark which is set in terms of the fast track option for DB funding, and just how high the hurdle is, which will impact the number of schemes going down fast track and the number of schemes which choose to use the bespoke framework. And climate change. I think the future of pension schemes, and partly from a legislative point of view as well as an investment point of view, it is going to be very, very green, and so I suspect that the climate change, as I mentioned with COVID, is going to be a continuing theme throughout the 2020s. But as I say, it's early days, so watch this space. And if we could move on again, please, I think that takes me to questions, and I will have a quick look at the chat box just before I hand over to Callum. Oh, just somebody asking, are we on the right slide? Hopefully I caught up. I will concede I played fast and loose with the slides, not covering every point in order, but hopefully all the bullet points on the slides have now been mentioned. No specific questions, so I'm going to pass over to Callum Smith from Barnett Waddingham, who's continuing the year in review. But I think Callum very much from an investment focus.
Yes, that's right. Thanks, John. Yes, I'm going to talk about the investment year in review. And just as a quick introduction, my name's Callum Smith. I'm a senior investment analyst at Barnett Waddingham, and I work on our strategy, research, and market outlook teams. So a lot of this work, a lot of the information we're going to see in this slide is work I've been kind of heavily involved with over the last year. So I guess to start, I'll just quickly run through. If we go to slide 19, I'm just going to quickly, to begin with, talk about the market background, what's been happening in the last year, both from a kind of economic perspective and a policy perspective, and then I'm going to move on to talk about how that's affected financial markets and a different set of asset classes in financial markets, and then talk briefly about how we see those assets changing moving forward. So if we go to slide 21. Okay, so the first obvious thing to talk about is the global pandemic. There's been a huge amount of deaths globally as a result of the pandemic, and these have been spread out all across the world. So we remember being locked down back in March and April. Back then, the disease was concentrated in Europe and the US, and there was a very high kind of peak of deaths at around 8,000 per day globally. But since then, even though for us a lot of the restrictions have been eased, we've had time to be able to meet people and go to pubs and stuff over the summer. That wasn't the case around the world, and even if it's at its minimum point in sometime around July, there was still 4,000 deaths per day annually. And back then, the disease was concentrated in South America, in Brazil, in Peru. Actually, Peru and Ecuador being the two worst affected countries as a result of the pandemic. Comparing, if you use the measure that compares the average number of deaths they would expect in a month compared to the number of deaths that actually occurred. So the disease was particularly bad in kind of emerging markets and never really went away. But of course, the disease has returned to Europe and the US over the last couple of months. We've gone back into lockdown, and we're still in some form of lockdown. Most countries have been in some form of lockdown right the way through the year. Obviously, in summer, restrictions were a lot lighter, but there were still restrictions in place. And even in our lockdowns, were quite light compared to some of the lockdowns in other countries. Obviously, people remember China's lockdown back in February and March, which was very, very strict, and people unable to leave their houses, kind of enforced by the army. That was true. That same kind of practice was used in other major economies, places like India, even in Italy. They were the kind of restrictions we faced. So the British lockdown was never as severe as other countries. And it's from these lockdowns that most of the damage has occurred, the economic damage, rather than the disease itself. Although obviously, of course, the lockdowns are a necessary response to combat the disease. So if we go on to the next slide, I'll just talk about the scale of the damage so far. This is by far the deepest global economic recession since the Second World War. If you look at specific countries, such as the UK, this is the deepest recession since something like 1710. It really has been a different order of magnitude compared to anything we've seen before. And what this chart here is showing is global economic growth in each year since 1990. And you can see the little red dot in 2009 is the financial crisis back in 2009. And then you compare that to the red line on the right. You can see the difference in scale this time around. So these projections for global economic growth are from the OECD, and they projected a 4.5% shrinking of the global economy this year, assuming there wasn't a second wave of the virus. Now, of course, there has been. And in that scenario, they projected 6.1% growth, minus 6.1% growth in the economy. As it happens, the actual second wave has maybe come a bit late in the year for that. So probably when they come out with their actual GDP results, we're looking at something like minus 5% for the year. And then the final line on that chart is the projected recovery back in 2021. So you can see that actually, despite all the damage we've had, people are projecting now that the economy will recover pretty fast next year. And these projections are from before the vaccine was announced, of course, which has changed. It certainly changed a lot of the way people think about the disease before there was the vaccine. We didn't know how long it could go on, and it's definitely a reason for optimism. However, the vaccines do take several months to roll out. Even though the UK was the first to approve the Pfizer vaccine, it's probably into the summer before a significant proportion of the population it ends up receiving the vaccine. And if you're in a country that didn't have access to, wasn't able to approve the vaccine so early, or purchase, significant quantities of the vaccine, kind of pre-ordered before it was developed, then it'll take a lot longer. So we're talking about a lot of emerging market countries there probably have to live with this disease well into 2022. So if we go to the next slide, and then you can look at the kind of real damage to the economy, rather than just the numbers, the statistics, what's actually happened to people. Different countries have taken different approaches to this. So in the UK, we used the furlough scheme to kind of keep people in jobs, even though they weren't working, but to provide that link to the employer and provide a degree of salary. But the number of people using the furlough was huge. Even back in October, before the last set of lockdowns, around 9% of the UK workforce was still furloughed, which is millions of people who have effectively been out of work for probably, by the time the latest set of restrictions are released, it could be up to a year. And that kind of long-term unemployment, even though it's not unemployment, still has a degree of permanent economic damage. It's a year lost of skills, training, and experience and development, and so that'll provide a drag on the economy going forward, despite the recovery. In the US, they took a different approach, and what this chart is showing is the level of US unemployment. So the line on the left is at the peak of the financial crisis, the peak of unemployment. Then the next line is the low we reached back in February 2020. The next line is the high we reached in April 2020, when the US made, rather than a furlough, they made millions and millions of people unemployed. And there you can see unemployment reached nearly 15% of the population, although it has since come down, and the chart and the last green line shows the level of unemployment in November, which is just above 6%. But in reality, that understates the level of unemployment, because unemployment is the number of people without a job, but who are looking for a job. And if you're not looking for a job, if you've given up on attempting to find a job, you're not counted in the unemployment statistics. So the reality is, millions of people in the US have left the labor force as a result of the pandemic, and so the real adjusted unemployment is actually much higher. It's closer to 10% still. Whereas in the UK, you can see that unemployment, this is at Q3 2020, so in September 2020, unemployment was about 5%, which was higher than it was. We were kind of where the US was back in February, the second line, but not as much higher, because so many people are using the furlough scheme. So if you go on the next slide. So, of course, with this kind of severe economic impact, governments have to step in. And they've increased their spending hugely over the last year. So in the UK, that's come through kind of furlough, more money for the NHS, tax relief, that kind of thing. There's been a huge amount of extra spending. In the US, rather than use the furlough scheme, they made a series of direct payments to citizens at $1,200. And there was there were intentions to provide another one of those so-called one-off payments, but the election kind of put paid to that, and we'll see if it comes again. But that's something markets expect, is another round of stimulus from the US government. For the UK, though, all this increased spending means a huge amount of extra debt. And the chart on the right shows the annual increase in debt to GDP. You can see the spike at about 2008, 2009, used to compensate for the global financial crisis. Gradually, we kind of reduced the deficit and we're starting to pay back some of that debt until, until the pandemic hit. The top of the 2020 line and the 2021 line show you that actually projections are that government spending will have to increase back up to the level it was at the financial crisis, but could go much higher, which is that red dot above the final line. It depending on how we recover from the virus, how quickly the economy recovers. So there's a huge amount of government response to this, and now a huge amount increase in the amount of government debt, which brings me on to the next slide, which talks about the other big organ of government, the other big organ of policy, central banks, and their response to this. They have cut rates to zero or as close to zero as makes no difference in all major economies. Any kind of recovery in interest rates that went over, that have been a big feature of investment markets for the last kind of 4 years before the pandemic, have just been wiped out, and every major economy is at zero, less than zero, or very, very close to it. And actually, things could still go further. I mentioned the less than zero there. The ECB has had negative interest rates for a long time, and it's something that the Bank of England has been thinking about. It's been kind of putting in place all the necessary tools and consultations and so on that would be needed in order to implement negative interest rates. So it's definitely something they're considering about if the economy were to continue to underperform or were to take a turn for the worse. And if we go on to the next page, we can see the other major response from central banks, which was quantitative easing, essentially buying assets, buying government bonds on a huge scale. So in the financial crisis, quantitative easing was largely restricted to government bonds. And you can see the kind of scale of the purchases on this chart on the right. This is the Federal Reserve, so this is the US central bank. Back in 2009, they were purchasing around $1.5 trillion worth of US government debt. And then there was two other sets of QE over the next few years, which are the two other spikes you can see on that chart. At around the same level, at around 1 trillion each time, as the economy was kind of slowly recovering. This time round, the Federal Reserve, for the first time, the Bank of England, not for the first time, they actually did this after Brexit, and the ECB did this, has done this several times already, but they've moved from purchasing government bonds to actual credit, corporate credit. So firstly, investment grade credit, and then high yield bonds as well. And in a vast scale, again, you can see from this chart, the current rate of purchases from the Federal Reserve is well over $3 trillion worth of assets. So there's a huge kind of market impact from this. And another way of looking at the scale is looking at the amount of government debt that these central banks hold compared to the amount of government debt outstanding. And you can see the Bank of England now owns more than a third of outstanding gilts. If you look at their own kind of projections, they actually say it's less because they assume that they will be able to sell the gilts back into the market at some stage, and that they won't be permanently on the Bank of England balance sheet. But if you look at what happened in 2008 or after Brexit, any purchases made then were never rolled off. So they stayed on the central bank balance sheet. So it's up to you to decide whether they'll be more successful in selling the gilts this time, but I suspect not. So if we go on to the next page, that is this kind of summary of what's been happening in markets. The biggest things, of course, are the pandemic and the economic damage, but the biggest thing for financial markets has been the central bank response, which has been fast. And if we go on to the next slide, you can see what this has done in different markets. So this is showing, firstly, I'm going to talk about kind of protection assets, about yields, because these are the most directly impacted assets from the central banks. And you can see the blue line is looking at the 20-year nominal gilt yield. And over the last few months, that's been as low as it's ever been. So this chart only goes back to 2015. And on the kind of left, you can see a fall in the blue line, which marks Brexit. And there's quite a big fall from yields around 2.5% down to around 1.2, 1.3 for a bit of a recovery. But if you take this on a longer scale, gilt yields are at all-time lows. They've never been this low before. Admittedly, that they're slightly higher than they were during the height of the pandemic. But yields have consistently stayed very low. And then the chart, then the red line shows implied inflation, which is obviously a kind of a measure that reflects real gilt yields as well. And you can see that stayed high, despite a fall in the middle of the pandemic, down to about 3%. It's recovered over the last few months. So real gilt yields are deep in negative territory now still, and again remain, very close to all-time lows. So if we go on to the next slide, but actually they could still go lower, because I talked about negative interest rates briefly on an earlier slide, but it's not just the central bank interest rate that can go negative. Gilt can go negative across the whole length of the curve, and they are negative in places like in Europe in particular. So this line is showing the yield curves for 4 different countries, and the lowest line, the blue one, is Germany, and you can see that Germany, which I think it's the longest dated government bond, is 30 years, and that is well into negative territory. At the date of this, it's still true, but at the date of this chart, this was the case, and they have been for a while. That's partially as a result of the kind of negative interest rates from the ECB. It's also a result of huge demand for German government bonds, which are the safe asset in the Eurozone. But they're not alone in having negative yields. In green, you can see the UK. We already have negative yields at short terms, with markets expecting that the Bank of England might cut rates into negative territory. That's slightly lessened in the last month or so since the vaccine was announced, but it is still a factor. And then also Japan, which used to have much more negative yields than this, and still does, until the central bank specified what it wanted the yield curve to be, something called yield curve control, and that it would buy or sell as many gilts as necessary in order to achieve it. So that's as well as negative interest rates. If the economy continues to struggle, there are several different monetary policy innovations that could come into play in the next few years or so. So if you go on to the next slide, and then I'm going to talk a little bit about inflation, or implied inflation. So I showed the chart earlier on about the increase in implied inflation, and again you can see it on this chart. You can see it falling quite sharply in the pandemic and then recovering, and obviously this is measuring RPI inflation. Realized RPI has been much lower than this, of course, and I think the latest figure is that it's 0.9%. Is the current rate of RPI inflation, and you would expect that. Big global recessions tend to be deflationary events. You tend to see inflation falling. The question, and then maybe what's being priced in the markets now, is how inflation will perform in the future. And the answer is we don't know. it could, you can make a strong case that deflation will continue, and that's my personal view, is that the sheer amount of unemployment, the kind of damage to the economy, and kind of different government stimulus policies, and the way government stimulus policies are targeted in particular, means that inflation will stay low. On the other hand, the other way of looking at it is, once the economy recovers, there's a huge amount of kind of pent up demand. So people who have been in which most people have been staying in work, have drastically reduced their consumption, and all that excess saving in cash will be able to boost inflation once things get more back to normal. Of course, the other thing here, when we're talking about implied inflation, gilt implied inflation in particular, is obviously the change from RPI to CPIH after 2030. This had surprisingly little effect on implied inflation. I have to admit that we were expecting a bigger impact. It's actually difficult to see the small impact on this chart. It's kind of not worth pointing out the size of the shift. What that says about the indexing gilt market is maybe something to consider. The implication is maybe that markets expect CPIH to rise in the future over a longer term horizon, but it's definitely something to consider and think about a bit more at this stage. If we go on to the next slide. So I'm now going to talk a little bit about return-seeking assets and how they have done. And if you're invested in a pension scheme, as you can see on the next slide, you probably know equity markets have had a fantastic few months. They fell back in March by about 32%. So this chart shows global equity markets. So they fell by about a third in March. But then since then, the recovery has been spectacular. If you invested at the bottom, you would have made returns of more than 60% since then. And year to date, if you'd done nothing, if you'd disappeared, if you'd gone on holiday to an isolated retreat for 12 months and just come back now, looked at your equity portfolio, you would have had no idea that a pandemic had hit, or that the biggest global recession since 1945 had hit the world economy. So actually, equity markets have done very, very well, but the recovery is very niche. It's in specific sectors in particular, and actually that, because of the different sectors, it's also reflected in different country performances. So UK equities are still down over the year. They, as of the 4th of December, they were down about 9% year to date, whereas the US is up 19%. And that's because the US has companies such as Amazon, Apple, Netflix, Facebook, Google, all the kind of big tech. They're not necessarily classed as technology companies, but tech-related companies, such as that, the so-called FANGs, who have performed very, very well over the year, and who have helped kind of drive this recovery in global equities. So if we go on to the next slide, and actually, it's not. And when you look at it again, in the context of this kind of huge central bank support that I was talking about earlier, it's not a massive surprise that equities have performed so well. So this chart on the right shows an estimation of the size of different publicly traded asset markets, and you can see that getting on for half-ish of the whole public market is equities. Government bonds yields have been low for a very long time now, and they've, as you've seen, have fallen even more as a result of this. So if you're an investor looking to put in money to generate some kind of yield, you wouldn't be putting your assets there. But as we've also seen, non-government bonds are now eligible for purchase as well. So central banks are taking up an increasing proportion of what's available of that on the market. And as we'll see on a later slide, that's had a massive impact on spreads as well. But ultimately, yields now don't offer you what they did even last year on corporate credit. And so the only place to go for these trillions and trillions of dollars, because it's 3 trillion from the Fed, I think 1.5 trillion from the ECB, something like in dollars about 500 billion from the Bank of England, and that's without taking into account the Bank of Japan, or even for the first time emerging market central banks have been making quantitative easing purchases as well. So there's a huge amount of kind of extra money coming into the economy. And the reality is, if you're looking for a return, equities were the only place to go. So it's not surprising that people have been pushed down or pushed up the risk spectrum, I guess, from safe assets up into riskier assets, and that a lot of this money was going to flow into equity markets as well, because we have zero interest rates, and we do for the foreseeable future. Equities which are expected to grow, such as companies like Amazon, have performed particularly well because their cash flows in the future are no longer discounted. If we go on to the next slide, as well, I think I'll just talk briefly about credit. So what this chart is showing is the green line is the change in the spread, so the increase in the spread from the 31st of December to the end of March, and you can see that there was a huge increase, something like 600 basis points for leveraged loans, 500 for high yield credit, in the immediate aftermath of the pandemic. But as central bank purchases have come in, as the economy has recovered, that's all more or less disappeared. In Euro investment grade, spreads are actually below the level that they were at the start of the year. And then the basic lesson from all of this is don't fight the Fed. If central banks are going to say that make a commitment to purchase an asset, this is the likely result. Much lower spreads. So there's been a big opportunity in credit this year. If we go on to the next slide, I think this is my final slide. I'll just talk briefly about another major asset market, which is property. And here the results have been slightly different because of the different sectoral impact that the pandemic has had. In particular, retail property has performed very, very poorly over the last few months, and this isn't a surprise. All the major shopping centres were closed for months at a time. Even when they've opened again, footfall has been down. There's been several big bankruptcies, and this was a trend actually that predates the pandemic of struggling retail clients. But the pandemic has just done nothing to accelerate it. The shift from physical retail to digital retail, places like Amazon, has been massively accelerated over the last few months. But then as well, of course, as this meeting indicates, we're all working from home now, or most of us are. Offices are empty. Offices have had, struggled to grow in value. They've actually kind of held their value quite well. But we're yet to see what the kind of long-term implications on the market are. But if you have property exposure, so long as your exposure to retail was quite minimal, you'll have benefited from that kind of central bank intervention. And you can see that in residential property as well, where there's been a huge amount of purchases there. However, if you do have an exposure to retail, you won't have had a good 2020. And with that is my final slide. So I am happy to look at some questions, or I don't know if we have any already.
I think there's one coming, Callum, but so far just for me. So okay. Just a reminder to everyone, we've still got some time left, so please do post in any questions that you've got before we wind up. But anyway, the question that was asked in respect of my presentation is, have you heard any word about an appeal on the Lloyds case? Now, this will be relating to the second Lloyds hearing on past transfers out. I have not heard anything formally on this, but at least one firm of pension lawyers is saying that they understand that the representative beneficiaries in the Lloyds case, that is the members, are considering an appeal. The reason for that being that although the case held that members with unequalised transfers were due a top-up, the High Court, Lord Justice Morgan, did not find for the representative beneficiaries on all points So there may be one of the findings that they're not happy with. Perhaps it could be related to the fact that they do not retain a residual benefit in the transferring scheme, where they were giving a past transfer out which was less than it should have been. Not much of the window left for an appeal to be lodged, and as I say, I've not seen anything formal yet, but there was a suggestion that there is going to be one. And I think it's also quite possible that there could be future cases on the GMP equalisation issue, because the Lloyds case has left as many unanswered questions as it has answered. Looking at Q&A, nothing else coming in. So Callum, I'll maybe just kind of open up the discussion there. I mean, as well as hugely instructive, I found some of the stuff on your slides absolutely terrifying as well. You know, what a year it has been, and you've covered that comprehensively. But one of the things, you know, that I was doing as I put my slides together is, you know, what are the kind of things that we're going to be looking at over the coming months and years. So from that kind of investment perspective, but if I can ask you to do a little bit crystal ball gazing as well, some of the things that should be on the radar for pension scheme trustees.
Of course. Well, I'll start with one that I'm sure would already be on everyone's list, which is Brexit coming up very shortly. Obviously, there's a risk of no deal, although it's not worth following the daily updates because they seem to change every day. But at the moment, certainly sterling is looking quite positive. You know, that we'll secure a deal. And actually, if you have an investment, that's probably the main avenue through which you'll feel the kind of effects of Brexit is through sterling. So in that case, it would be worth looking at or being aware of what your current currency hedging levels are for the impact of that. But not to dwell on that too much, because I think everyone's well aware of Brexit. Looking further ahead, I'd say the biggest implication is still the biggest factor in investment markets will be what central banks do. Essentially, we go back to for the last decade. Effectively, central banks have been determining what happens in financial markets. If they provide more stimulus, financial markets are happy. If they provide less stimulus than was expected or raise rates faster than markets expected, markets tend to fall. And what we'll see over the coming months is effectively that, but increased even more in intensity. If central banks look like they decide the recovery has taken hold and look to kind of wind in the amount of stimulus, I think markets could be in for a bumpy ride. But if, as we expect, they kind of, because of the economic damage, they maintain the stimulus for quite a long time, even after the diseases, the pandemic has been brought under control, then I think there's still big positives in markets. You know, looking at the spreads on credit, you know, we think they're back down to where they were at the start of the year, but they could easily go lower. Back at the start of the year, that wasn't a low point for spreads. Spreads been lower earlier in 2019, and even lower in previous years. So we think, you know, there's a good chance spreads could go lower. There's a good chance kind of equity markets benefit both from the stimulus and from the economic recovery, bringing up those kind of laggards that have been in trouble over the last few months. So, but yeah, essentially, to predict financial markets, you have to predict what the central banks will do over coming months.
I suppose kind of, but more generally, the huge amount of debate around, you know, the shape of the economic recovery, you know, V-shaped, U-shaped, W-shaped, a wonky W, something that looks a bit like the Nike symbol. Your kind of thoughts on that, but how it's panning out?
So I think we're well past the point where a V-shape was possible. Because if you look at the economic recovery so far, going back to, and here talking about the UK, GDP growth fell very sharply, then it rose very sharply. It looks like a V. However, in the last couple of months, the GDP growth has kind of leveled off at about 8% lower. So the size of the economy is about 8% lower than it was at the start of the year. And that's what I think we'd expect to see, kind of like the Nike tick kind of shape, with the fall, the rise, and then a longer recovery period is probably what we're likely to see. Of course, that depends on how lockdowns go. If we go back into national lockdowns in January, February, which is entirely possible, then we're probably looking at a double dip recession. So it all depends on government policy.
Yeah, I mean, it is going to be, what happens with the Christmas period. It looks at the moment like we're still getting the loosening of the rules, but it's what price might have to be paid for that, isn't it?
Well, yeah, absolutely. And if you look at because we do have a kind of trial run for this in Thanksgiving in America, which it was in November, of course. And actually, there has been quite a big spike in cases in the US after Thanksgiving. So yeah, I suspect that's what we might see in January.
My sentiments as well. I mean, the American experience is just the stuff of nightmares. I think now there's 300,000 deaths.
Mm-hmm. Yes, of course there are much bigger countries in America, but at the same time, it's interesting looking at the distribution of the deaths, because if you look at America back in March, the worst place was New York and New Jersey by a long, long way. Most of the deaths were New York, New Jersey. But over the summer and into the winter, you can trace the path of where the hotspots were. And it's only now we're returning to New York. So back in the summer, it was kind of places with air conditioning that tended to get the Arizona, Texas, places like that bore the brunt, where people were inside to stay out of the warm. Over the last couple of months, the worst places have been kind of the northern Midwest. So places like North and South Dakota have been particularly badly hit because they tend to get coldest earliest. And now the combination of Thanksgiving and moving into the deeper winter means actually, we're returning to New York and places like that, which they've been there's a reason densely populated, very cold places have had such high spikes in the past. So hopefully we can do something to avoid that.
Yes, I booked my summer holiday at the end of last year, and the intention was New York, Washington, and Florida. Now, of course, it's all been cancelled, but it looked as though it was going to end up being like a tour of the COVID hotspots over the period in question. So I think enough said on that. But we have got a question for you that has come in on the Q&A box, and it relates to something that I did mention as a theme of the 2020s about investment being increasingly green. And the question to you is, how will the introduction of green gilts affect pension schemes?
I don't think it will. In short, I don't see any reason why pension schemes would invest in green gilts. I think that's maybe sounds a little harsh, but the reality is, if you're using gilts to hedge, then you can get a better yield on normal gilts compared to green gilts. And if you're investing in green gilts for environmental reasons, actually there are much better places to put your money. It would be much better investing in some kind of moving to climate aware funds, or using some kind of impact investing approach if you're large enough and have that kind of conviction. I think that would be my opinion, certainly on that. I think there are better, more efficient, more effective ways to use your money than green gilts.
Okay. So I mean, on that sort of more general issue, the ESG and climate change, obviously we see from a legal perspective more duties on trustees to say what they're doing in this area, but that's just words. What are you actually seeing in terms of changes in investment habits, and is it very early days yet?
Yeah, I'd say it definitely is early days, but we have seen moves. I mentioned kind of moving to kind of climate aware versions of funds, which are increasingly available, and I've definitely seen a few clients move into that kind of fund, essentially shifting their existing investments into something a bit more friendly from the ESG perspective. And again, for those who are particularly committed, I've seen some investments in kind of impact funds looking to make a much more direct impact. And I think that's, as you say, it's early days, but definitely over the next few years, these will be increasingly important themes. And we do expect to see more kind of movement into these types of funds.
Okay, just one last look at the Q&A box. Nothing new coming in, so I think that just leaves me to sum up and saying thanks to everyone for attending the webinar, and a special thank you to Callum Smith from Barnett Waddingham for absolutely fantastic talk in a year that I think for all of us in the financial services sector has been interesting times, but perhaps more for people in your area than anyone else, Callum, and probably no let up in 2021 either.
Yes, well, no, thanks for inviting me. It's been a pleasure to speak.
Okay, so thanks again, everyone. We will see you in the new year. I hope everyone has a very happy and safe festive period, and enjoy the rest of your day and week. Thank you. Bye.